Mr. Hassett, always great to see you, sir.
Yeah, thanks, Tyler. Great to be here.
Delighted to have you with us. As you look back at 2018, what do you think the final growth number will be? And as you look at the current year, 2019, do you think the economy is slowing, and if so, by how much?
Right. Well, first for last year, at the beginning of the year, about a year ago, we took a lot of flack at CEA for saying that we thought economic growth would be about 3.1% in 2018. Right now, if fourth quarter comes in at what we expect, which is, about 2.5%, then the 3.1 for last year is going to look, spot on. And so then the question is, going forward, is there some reason why we would change our models? And I know that there was some disappointing numbers in January, and in December, the retail sales were a little disappointing. But, smoothing through the ups and downs of that, sentiment has rebounded a lot in February. And so we're sticking with our guns, and we're going to say that we're going to have another 3% year. And a way to think about it is we started the year with a 300 jobs number, and almost most quarters that start with a 300 jobs number in the first month end up with growth north of 3%. And so that's what we're looking for the year. But even the slowing that is in some of the indicators, I don't think is a really serious thing in the first quarter.
So still another 3% year, back-to-back 3% years would be something certainly to crow about. We hear not all that often, but often enough that it seems a little bit like it stands out. We hear some analysts saying that they wouldn't be surprised to see the country dip toward a recession toward the end of this year or in 2020. What would you say to them? Is that a reasonable fear or not something you see?
Well, there are people who say that all the time, right? And the fact is that there's an enormous amount of momentum, as you said. We've got a 3% year, in the bag pretty much for last year. This year we started with the 300 jobs number. We're carrying a lot of momentum forward. And don't forget that the capital spending that drove growth last year is going to produce output this year. So they built factories last year. They're going to flip the factories on this year, and we're going to get growth from that. And so I really have a hard time seeing a recession developing this year. The fact is that unconditionally, which means if you didn't know what year it is, then the odds are about 18%. For this year, the odds got to be way, way below that, like maybe 1 or 2% or something like that.
Kevin, it does appear the consumer is in great shape, but they're not very happy right now over the tax refund issue. What mistakes were made in retrospect that could have corrected this? And is it just a one-off, and will things be better next year? What are your thoughts on how this has played out?
No, I don't think that. Well, first we can talk about consumer sentiment. It rebounded a lot in February, but I don't think that it's a mistake, right, to make people withhold the right amount. And so what Secretary Mnuchin and the team did in February, and they really should get gold stars for this, is that they revised withholding so that the tax cuts would go right into people's checks right away. And so the fact is that people got their tax cuts, and they were visible in their checks last February, and that's one reason why we had a 3% year last year.
Right, but they feel like they've spent it along the way, and then the usual amount that's available to pay some bills that maybe had piled up or trips or what have you this time of year, that number's not there. So I understand what you're saying, but it still doesn't help that people feel like they weren't prepared for this. So was there any way that
the Treasury technical staff is sort of disputing some of these stories, and so I haven't really dug into the weeds about whether in the fullness of time we're going to see smaller refunds.
In our zip code, I'm sitting around the pod and I'm hearing stories of one guy's refund was half of what it used to be. One went from getting a refund to owing money.
So the question is, would you rather have your money now or a year from now, right? You would rather have your money now.
Yeah, they're not furious, but it's an inconvenience, and for some people, it's a pretty big one.
Well, sure, and we'll follow the thing closely, but it's really, really early in the season, and we'll have to wait and see. I mean, most people are going to be filing in April, and so again, the Treasury staff, I think, they've disputed to me some of the accounts we've seen out there of that issue.
We want to get to trade. We want to get to the possibility of auto tariffs on Europe, but I want to come back to something you said a moment ago, and that was that the capital spending that went into the economy in the form of factories built or expanded last year is going to produce output this year. Give me the numbers, because I think there is some suspicion that some of the money that derived from corporate tax cuts really didn't go as much as we would have wanted into capital spending, but rather went into buybacks, and that has been a criticism of the 2017 tax law. Take us through the numbers on capital spending versus buybacks.
Yeah, thanks for that question. I love the numbers. So the fact is, if we go back to the fourth quarter when the tax cuts were passed, then the cost of capital, which is the key number people look at when they're deciding whether to build factories and buy machines, was going to drop, we said at CEA, by about 9% in 2018, which we said would make capital spending go up by about 9%, because you see about a 1-to-1 response. With the numbers that we have through the third quarter, counting the fourth quarter surge in equipment, which was retroactive, and so you should count that for the tax cuts, then we have total capital spending up 8% last year. And so it's almost exactly what the model said. And now that 8% increase is going to produce output this year.
And right. Kevin, I'm sorry, just to follow on from what Tyler was saying, that goes a long way towards helping explain some of the benefits. At the same time, look, 2020 is approaching. You've heard a lot of the proposals as ways of raising revenue, which are saying, all right, we're going to increase the capital gains tax rate. We're going to increase the dividends tax rate. We're going, and so on and so forth. And they point to the deficit that in part is caused by last year's Tax Cut and Jobs Act. So is there an efficient way to raise more revenue?
Well, I mean, the efficient way is to grow the economy at 3% instead of 2%, and to do that for a long time. But, we were looking at the numbers just last week, and for goods-producing workers, these are the people that President Trump has created a heck of a lot of, or his policies have created a heck of a lot of goods-producing jobs. Their weekly earnings went up last year $48 a week relative to trend. That's about $2,500 a year. Now, that $2,500 is going to be poured back into the economy. It's going to, create consumption for those folks, and they'll have to pay a little bit more tax, too, because of the higher income. That's how we get the books balanced in the end, is with growth, not with higher tax rates. And you saw that there was a proposal for a wealth tax, and for CNBC viewers, imagine if there's a 3% wealth tax. Well, the way that you figure out the capital income tax equivalent is you compare that to the income that you would get from the wealth. Right now, the risk-free income for wealth is a little bit less than 3%, and so a 3% wealth tax is more than 100% tax on capital income. And now, I just don't know any economist who thinks that a tax rate greater than 100% on any kind of income is going to produce a positive outcome, but that's the kind of proposal we're seeing in Washington, sadly, right now.
Kevin, the latest CBO numbers gave you guys some credit. They raised, I think, the GDP growth by $750 billion a year relative to the previous projection. That's a huge increase. Raised borrowing costs a little bit, too, but still thinks we'll have trillion-dollar deficits by 2022. Is it possible that they'll be proven too cautious based on growth? Because even this year, we're starting off a little bit weaker than last year.
Right. Well, if you go back about, a year, a little bit more than a year, I think the summer before the tax cuts passed, they were saying that 2018 was going to be in the low 2s. And then we got something in the low 3s, probably. And so pretty much they keep going back to this fact that we've got a 2 or 1% growth rate that's attracting the economy. But that view, I think, is going to be rejected by the data as we move forward, because, really what happened was that economists around the world really accepted that we have a new normal of low growth that was almost given to us by Martians. And our view in the Trump administration was that there's no new normal. It's just that we've got bad policies, and if we fix them, we can go back to just normal. And really almost for 2 years of the Trump administration, we have gone back to about normal, and we think that that'll continue. And as it does, we expect that the CBO will start to recognize that as well.
Has the tax cut paid for itself, or will it?
It certainly hasn't paid for itself yet this year. The thing that you have to think about is that there are lots of different components of the tax cuts, like, so for example, the child credit. The way that the corporate income tax could pay for itself is it causes all this investment and all this output and higher wages, and you get more revenue. For something like the child credit, which is supported by Republicans and Democrats, you get a much lower growth effect, right? But in the end, if we grow 1% a year for 10 years more than CBO said a year ago, then absolutely the tax cuts will pay for themselves.
Let's switch to trade and tariffs, if we might, and try and get a 2-for-1 here. Give us the latest news on the status of the trade talks with China, which resumed this week in the United States. Do you think it is likely, unlikely, somewhere in between, that those tariffs will go up from 10% to 25% on the $200 billion worth of goods? And then walk us through what's happening with Europe. Does Europe need to be worried that the administration is going to slap tariffs on their auto imports?
Well, the president and the rest of the economic team, we were briefed by the folks from China over the weekend. That's been covered in the news. And, my job right now is to not get in the middle of the negotiations and comment on them. I know the president tweeted something about progress, and so I think that could go as sort of like the statement of the administration on the China progress. The fact is that the conversations are still going on. There's still a lot of progress to make, but I think that they're still going on, and that's a positive sign that they've made progress in the past. past. And so, but the president has tweeted about that, and I know there's still a lot of work to do. With regard to Europe, I think that one of the things that you've seen is that the president is really, really serious about reforming our trade deals, and that he's willing to use tariffs to, if people have tariffs on us, to make sure that they play fair with U.S. companies. And so there are a lot of U.S. companies and U.S. exporters that aren't treated well by Europe, and President Trump's serious that they need to reform that, and if they don't, then he's going to think about ways to reciprocate it. And so the Secretary of Commerce issued a report this weekend, and I know that and other things are being considered by the president at this time.
Kevin Hassett, thank you so much for being with us.
Thanks for having me.
Always great to see you. Kevin Hassett
Thanks.
of the CEA.